As we briefly talked about in the last video, the taxation of capital asset gains or losses are treated differently depending on whether it's a long-term or short-term, depending on whether or not it's a gain or a loss. And so we're going to look at that right now. So the taxation of your capital gains can be a little confusing, and the deduction of your capital losses can be a little frustrating. So the first thing we're going to look at here is there's different tax rates for the different types of the taxable gains. As we talked about on the last video, your short-term gains are treated just like ordinary income. So whatever your income tax rate is, that's what you're going to pay for your short-term gains tax rates. So long-term gains, on the other hand, are taxed at either 0, 15, or 20%. Which one of these you get to use depends on your taxable income level. So for a single person whose taxable income is below $40,000, long-term capital gains are taxed at 0%. Married filing jointly, if your taxable income is below $80,000, you're taxed at 0%. So if you're married filing jointly, you have taxable income of about $60,000 and you sold something and made $10,000 long-term capital gains, you're going to pay 0 tax on it. Long-term unrecaptured 1250 gains are capped at 25%. You don't see this very often. 1250 gains, 1250 properties, more like a real estate, buildings, land, etc. And so unrecaptured gains are capped at 25%. And collectibles like artwork, museum pieces, that type of thing, if you buy and sell those, which again, we don't see this very often, their rate is capped at 28%. So we do have to order them in some way, shape, or form, obviously, just due to the tax rates that we have. When you have multiple types of capital gains, the taxes are calculated in a set order. So the first one is your short-term capital gains. Of course, you know, that's the highest tax rate you might have, so you're going to get taxed those first. Your 1250 gains, again, on property and whatnot, and then the collectibles, and then your long-term gains. So you can see quickly it tries to get you to pay the highest taxes first, and then when you get to the preferential taxes, that's when you get down to the last item. So the IRS really stacked the deck in their favor. So your net capital position, this is something else we got to look at here. If you have both losses and gains, you've got to calculate your overall position in that capital. Like we just looked at, you can have 4 different capital gains: short-term, long-term, the one on 1250 property, and the one on collectibles. Now, the 1250 and collectibles, we don't see that often. But on the short-term and long-term capital gains, we see that all the time. And so that's what we're really talking about here. And so we're going to look at what our net capital position is for these items. 4 steps. It sounds really complicated, but it's really not. I mean, it's basically group all the long-term stuff together, group all the short-term stuff together, and then group the long and the short-term together. But the book made it complicated. So here we go. We're going to look at it. Step 1, you group your gains and losses into short-term or long-term. So imagine you have, baskets of long-term gains, short-term gains, long-term losses, short-term losses. So we've got them all grouped up in our gains and the losses into either short-term or long-term. You net your long-term gains and losses. So you take your net long-term gains and subtract the net long-term losses. So we've just netted everything that was long-term. And then we would net our short-term gains and losses. Take your net short-term gains minus your net short-term losses, and you have your net short-term gain or loss. And then fourth, you net your long and short together. So this is, again, 4 steps, but really it's just add your long-term stuff together, add your short-term stuff together, then add the long and short together. So let's look at an example of that. You have a $500 long-term gain, a $100 long-term loss, $300 short-term gain, and a $400 short-term loss. So step 1, group your gains into long-term and short-term, which we've done here. We have a $500 gain, long-term gain, $100 long-term loss. Short-term, we have a $300 gain and a $400 loss. Second, net your long-term gains and losses. So our $500 gain minus our $100 loss equals a $400 long-term gain. If this had been reversed, if we would have had a $100 gain and a $500 loss, we would have a $400 long-term loss. Then we're going to net our short-term, which we'll see with that here. We got a $300 gain minus a $400 loss. So we have a $100 short-term loss. And then you now net your nets. $400 long-term gain minus your $100 short-term loss equals a $300 long-term gain. And again, if these would have been switched around, maybe this would have been a $400 short-term loss and a $100 long-term gain, we would just have a $300 short-term loss. So pretty simple. You're just netting everything together to get to the bottom line here. All right, so what do we do with capital losses? We've grouped everything together and we actually lost money from selling capital losses. Capital gains are fully taxable in the year earned, with a couple of exceptions which we get to at another time. Net capital losses are not. Again, the IRS stacks the deck in their favor. So, you know, I remember in college, my professor said, anytime you're wondering which way you should go with the way that gives the IRS the most money, because that's probably the right answer. So you have to pay your tax on your gains all at one time, but your losses, you don't get to. You can only deduct up to $3,000 of capital losses per year. Okay, so your net capital losses are only deductible up to $3,000 for the year, unless you're married filing separately, and then you only get to deduct $1,500 a year. So this $3,000 goes for whether you're single or married filing jointly. There's no doubling of it. It's $3,000 is the most of your capital losses you can deduct each year. Losses in excess of the $3,000, you just carry them forward this year. So if you have a $30,000 loss, we're going to deduct $3,000 this year, carry $27,000 forward into future years. Next year, you'll subtract another $3,000, then you'll carry 24 forward. Next year, you'll deduct another $3,000, carry 21 forward. This can go on for quite some time. I have clients who have capital losses in excess of $100,000. They're not going to live long enough to deduct all of that loss at $3,000 per year. And losses maintain their long-term or short-term gain. Now you do get to net them again next year if maybe you sell something. And now we can do that netting again. And so maybe we'll get to deduct our losses quite quicker. That makes no sense. We might be able to deduct those losses quicker. All right, so let's take an example here. After netting your long-term capital gains losses, you have a $10,000 long-term capital loss. After netting your short-term capital gains, you have a $5,000 short-term capital loss. On your current return, you will deduct $3,000 over the short-term capital loss and carry over $10,000 long-term capital loss and $2,000 of the short-term capital loss. So remember, losses maintain their long-term or short-term nature. So now since we had overall losses altogether, we got to maintain the structure of them, the character of them, whether it was short-term or long-term. So, and we deduct short-term losses first. So the $3,000 of this is going to be deducted. None of this is deducted in the current year, so it's carrying forward, and then the remaining $2,000 of this gets carried forward into next year. So next year you'll have a $10,000 long-term loss and a $2,000 short-term loss, which you'll be able to deduct. Next year, if you have no other gains or losses, you'll deduct the remaining $2,000 of this and $1,000 of this to max out at your $3,000, and then you'll carry $9,000 of a long-term capital loss into the future years. Yep, I should have waited. Yeah, I would have seen that we had that typed right here. But anyway, that's exactly what I just said. Okay, so why does it matter? Now, here's some ways we can kind of mitigate some of these issues. This came from a client whose tax return I just did. Today is October 10th, 2020. And I just did this tax return yesterday. And this guy has a really smart CPA. So as you can see right here, and this is a stockbroker form. We see these a lot. These are called a 1099B. And what this does is this tells us all your stock transactions you have. So you can see, here's the stock. He sold Facebook. He sold 300 shares of Facebook that he bought on October 16th of 2014. He sold it on April 25th of 2019. So this is more than 1 year. So this is a long-term stock that he has. Proceeds, $59,000. His cost or basis was $21,000. So he had a $37,000 gain. Now, he probably called his CPA, who's very smart and kind of good looking, and said, hey, I've got this big gain. What am I going to do? And now I told him, well, since you're in long term, it's going to be taxed at the 15% bracket. So just plan on, you know, what is that, about $5,000 of taxes here and you'll be good. But of course, then we get to net stuff together. We net our gains and we net our losses. So his smart CPA probably said, do you have any stocks that aren't doing so well that you don't think will recover? And he said, why, yes, I do. And I said, well, if you'll sell those before the end of the year, we can net it together and then you'll cut down on your taxes. So look here, right here at the end of the year, he had this investment in Weatherford, have no idea what Weatherford is, that he bought in 2013 and a little piece here in 2015, and he sold them all in 2019, so it's long term. But you can see here, his proceeds, look at this, piddly, $54. But look what he paid for it way back in 2013 and 15. He paid $36,000. So now he has a $36,000 loss. And you can see here, the brokers will add all your stuff up by the long-term or short-term and whether it's gains or losses. So he has a net long-term capital gain of $37,000 from his Facebook sale. And then he has a net long-term loss of $36,000 from his sale of Weatherford. So now when he nets his long-term gains and losses, he's going to have about a $1,600 net long-term capital gain, and he'll only pay $240 instead of the approximately $5,000 he would have had to pay up here. So that's where a little tax planning comes into mind. And I always tell my clients, tell your CPA or your tax guy what you want to do. Don't tell him what you did. Because if he would have waited till 2020 and told me, hey, by the way, I sold all this and made some money, what can we do about it? I'd say, well, there's nothing we can do about it now because the year is already ended, so we can't do anything. But since he talked to his tax guy, who's really smart, before the end of the year, we were able to do some things to mitigate the taxes that he would have had to pay on this. So that's why this kind of matters. So one of the biggest capital assets that most people have is their personal residence, and we're going to look at how we tax that coming up in the next video.